I mean, Hindalco, BEL, L&T, Tata Motors, BPCL, Coal India, these are the 2% kind of cuts which are coming at this stage. Maruti is up 3%, it's the top gainer, but there is Titan, Eicher, Nestle, etc., which are up as well. But very few stocks, about 5 names out of the 50 names are higher. And I think we should be able to put up the heat map now as well. So 200 lower on the Nifty to begin the day. Rupee.
Well, the Indian market's showing a fair amount of resilience in the backdrop of the whole global sell-off. Talking about the Nifty, the losers right now include Hindalco, BEL, L&T. There is Tata Steel also slightly lower, Tata Motors, BPCL. So it's across the board really. Trends are hard to find. But yes, you can say some of the more global-facing names, for instance, metal stocks, they're coming under more pressure. And there is some continued selling in the CapEx names at this point in time. L&T, for instance, down about 1.5%. Maruti, Eicher, Titan, Nestle. This is exactly the commentary you've been hearing over the last 1 hour. The market expects, at least in the near term, discretionary CapEx companies and stocks to do better. And that's where the buyers are gravitating. Let's see how it plays out. ITC, Lever are absolutely at the flat line. Let's check some of the bigger banks. HDFC Bank, down about 1.5%. Bank Nifty itself is down about 1.2%. ICICI Bank is also lower, about 1% lower, and SBI also 1% lower. So a little cautious, but let's see if we can kind of recover from the lows.
Well, the Nifty Bank is at a very, very crucial mark. It's moved to the 20 DMA, and as we speak, is just flirting with that 20 DMA. So that's the very, very important mark that we're talking about for the Nifty Bank. Keep an eye out on that. Stocks that are moving around. Oncology-focused hospital chain, Healthcare Global, that's up close to around 5%. So good up move is what we're seeing on that one. KPI Green, from the top, the stock had corrected close to around 50%. The last few sessions, it's been moving from circuit to circuit. Commissioning of units is what we've seen out there. So that stock, in fact, is up close to around 5% as we speak. On the flip side, you have Dreamfolks. That stock has opened gap down. So keep an eye out on that one. Blue Star as well is down close to around 5%. Volumes as well fairly large for the first couple of minutes. Persistent Systems, that's another stock that's lower in today's trading session. So just keep an eye out on that one. And Zensar, I recall that stock, in fact, it went up big time on budget day. I think it was up 7-8%. And last week itself, it had a very, very good run. But Zensar today is giving up some part of the weight that it's put up. A few more stocks to note. RVNL, some of those railway-related plays, that stock is a little bit lower. IRFC as well is down close to around 3%. And I think the oil marketing companies, you had HPCL, IOC as well as BPCL, all of them pulling back a little bit in, quite a bit actually, in the pre-open. And that's what the rate stats are as well.
Absolutely, and 200 points lower on the Nifty is what we have. We are at 23,256, so lots of stock-specific moves. It's early, but declines to advances is 6:1. 6 down for 1 up. That's essentially the tally that we are looking at. Well, let's welcome in our market master of the day. Is one of the largest fund managers in equity side in India, S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential AMC, is joining in. Naren, it's a great day to have you with us here on the program. Thank you very much. Great day not for the market, but important day, let me rephrase. Naren, how are things set up according to you? The budget, what were the 2 big sharp points that you took away from it? There's this tariff bit. Expectation is it'll blow over. It's not permanent. And of course, there's monetary policy ahead. Where does all of this leave markets?
No, clearly it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. And of course, today it has been taken over by what has happened in US on Saturday night. So we have a situation where the budget is no longer the central piece at this point of time. It has been taken over by that. But that's where we are. But having said that, this was needed because over the last 3 to 4 years, we have had a situation where the infrastructure and capex side of the economy has done very well, but the consumption side of the economy had not done well. So, as contrarians, we have always believed that, you will always have these cycles, and therefore the consumption side of the economy had to do better, and the budget gave that shift. So it's a very positive budget from that point of view, and it is the right thing to do at this point of time.
Naren, we had Neelkant earlier, who you know well. And I asked him whether the messaging from the government is shifting away, taking the pedal off infrastructure spending, because maybe that's not, I mean, the government can only do that much, the central government. Definitely it is focusing on consumption. As a money manager, Naren, what does it mean for portfolios, you think? You think there will be a difficult shift away out of these infra kind of names to consumption names? You've complained about the very high valuations, infra, capex, etc. kind of stocks have traded at.
Yeah, actually, for us, it was very logical that, for example, there was a time when we used to complain about very high valuations, consumer stocks. And for a change, we do have consumer stocks in our value fund, for example. So I would say that, this kind of shift was very logical on the part of the government. And so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well. I think that is the role of the government and the regulator, and that's what they've been doing. Last year, for example, the regulator actually slowed down personal loans. That was again a very good step. So I believe these kind of steps have to be done on a continuing basis. And as fund managers of public money, we also have to be very cautious in sectors where things are very costly. So we have been cautious on small and mid cap. And we have been more positive on sectors which we used to be very negative on, like consumer staples, etc. So I think that's the way things should be. And that's the way I think long-term money is made, actually.
So, Naren, hi, great to have you with us this morning. So this is exactly what we were sort of discussing with Neelkant as well. The question is now, what is the change in the portfolio? And I'm not talking about short, tactical trades here and there. I'm talking about someone who's looking at least a 1-year portfolio, 2-year portfolio. Would you recommend that that person cuts down on capex a little bit and loads up on consumption, discretionary consumption? Or no, because you yourself are saying that it's not like the government is taking the focus totally away from capex. From a portfolio stance, 1 to 2 year view, what is the kind of directional change that you would recommend, if any?
See, I think from a portfolio stance, what we've been saying is it is actually small and mid cap, which is really very costly. And that is the area where over the last 1 year, we've been advocating people that they have to be cautious. So we closed our small and mid cap for lump sum investment as a result. And that is the area where I would say that even today, after the correction, valuations are still much higher than large caps. So that is the area where we would be even more careful. And I would say across various sectors, small and mid caps have got overvalued. And that is a bigger problem in the market than even large caps across. If you look at large caps, I would say there aren't too many large caps in the infra capital goods space itself, so that for us to actually really think about. And that is where we are being careful. And still, I would say you have to be careful in small and mid caps in various capital goods space or infra space. In all these spaces, you have to still be careful wherever the valuation has gone up too much. But I would say you have to be careful in capital goods, in small and mid caps across sectors.
All right. Hi, Naren. Good morning and good to see you. And you've been making this point, right? Cautious on the broader markets in comparison to the large cap names. Naren, earlier this morning, we were highlighting a few of those stocks, like the chemical stocks, some of those molecules in the US, that they export out there, that could get a bit of a booster shot because if these tariffs are imposed on China. In that backdrop, I wanted to ask you, what is your contra play you're looking at? Is it chemicals? Is it metals? There's a lot of uncertainty out there. Or is it cement? Some of these sectors haven't done well. So that's why I'm just pointing out a few. But what would be the big contra theme that you're looking at?
See, clearly our contra theme over the last 1 year has been asset allocation because people are just not willing to invest in debt. Clearly, chemicals was one such contra theme also, but it is not a very large sector. But chemicals has done very badly in the last 3 to 4 years. So that it was a contra theme, if you ask me, but not a large sector from that point of view. But our contra theme has been asset allocation because no one was willing to invest in debt. And it was such a trouble to get people to think of even asset allocation and hybrid funds in a big way because people said, we'll invest in small cap, we'll invest in micro cap, we'll invest in SME IPO. but we will not invest in asset allocation. So our big contra theme actually was to choose people to invest in asset allocation. And today, as we speak, it's very heartening to note that today many of the hybrid funds that we run have delivered as well returns as many of the small cap and mid cap over the last 1 year, primarily because of the last 1 month. And that's been a happy feeling, because most of the time we used to be questioned as to why you are recommending cautious stances all the time. And that has worked luckily in the last 1 month.
Naren, just to come back on consumption, where you've said that you recently started taking a little more positive stance on the sector. I'm just trying to understand what kind of re-rating or multiple expansion can we expect? Because the other argument is that, how much do you want to pay for, say, 4-5% volume growth? I'm talking about consumer staples. So do you see those multiples going back to the heydays of 60 times, 70 times? And again, if I talk about the other end of consumption, where growth is visible, now whether it's Trent or Zomato, these new age consumer stocks, discretionary consumption, jewelry companies, hotels, what is a reasonable level of PE expansion that you would be comfortable with?
This is a complicated question, and this is what we keep debating. Frankly, yet we are not yet in a situation where it's possible for you to actually bet that things will zoom up from here in consumption side. I think because the sectors have got re-rated already in 2-3 days significantly. So, we have to do a fair amount of bottom-up thinking. And I don't think we are in a situation where you can get big returns from the market at this point of time, which is why our recommendation has still been asset allocation over everything, large caps over mid cap and small cap. Clearly avoid SME kind of areas, avoid unlisted kind of areas. This is what we're saying. We're not in a phase where you can make mega returns. That doesn't mean that these stocks are going to fall from here. I don't think that is also true at this point.
Right. What about Naren? Asset allocation has been such a big talking point for you over the last year and a half, maybe 2 years. Gold has done so phenomenally well, Naren.
Yeah.
This is amazing. Almost $3,000. What's your view from here, Naren?
It's impossible to tell people at this point of time when you're doing asset allocation, invest in gold on just like that, because gold is a phenomenal asset when you see the geopolitical problems at this point of time. That is why multi-asset is the only way in which we can think of gold now, because there's just too much of problems on the geopolitical side. Each country wants to levy duties on other countries. So at that point of time, some investment in gold is okay from an asset allocation standpoint. But would we like to recommend standalone investing in gold and silver at this point of time? I don't think so. I think that phase is over. That phase of being very positive on gold and silver standalone is over for us in our framework.
Okay, but relative and part of the portfolio basically, right?
Yes,
that continues.
exactly.
Naren, I think about a year ago, you said for the next 5 years, actually maybe it was 2000, late 22, you said we are entering a period of macro markets for the next 5 years, maybe even longer. Do you still believe that, Naren?
Actually, you see the Saturday night's event, that itself shows that we are in a macro market. And in a macro market, asset allocation works. And that has been our central thesis under which we have been working. And I think we are in a macro market. And it is only good thing is that India's macro is in good position. So we are less volatile than the world because our macro is in good position. That is all that we can say. Otherwise, I would say that we are in a macro market. And if your country's macro is in bad shape, then the volatility will be very high. If India's macro is in good shape, so the volatility is lower in all the asset classes. That's all. That's how I look at it.
At a broad level, Naren, what about global-facing companies? Those are what's the view? We've spoken about consumption, infra, etc., all sort of local-facing. What about the ITs and the pharma and metal mining? Those what's the view there?
See, obviously, IT are more defensive. IT and pharma are more defensive global-facing companies. They are therefore slightly less volatile. Global facing not so defensive sectors like metals, they're going to be very volatile. But if you see over the last decade, they have not done that well. So they've actually got derated over the last decade. So you can't say you will never look at them because as it is derated, over the last decade. So if you're prepared for volatility, they'll be more volatile than the market. But is it bad to consider them for some small investment? May not be. You can consider small investment, but at the same time, they'll be more volatile. IT and pharma will be less volatile, but they are not as cheap as the global cyclical sectors.
All right, Naren, if you could spell it out for us, what should the asset allocation be as of now? I recall in Diwali time, I'd asked you what would your view be on fixed income, and you said it very, very candidly at that point of time. And at that point of time, you were in minority. You said maybe fixed income does better than small and mid caps, and that's the way it's played out. So at current reckoning, what would your asset allocation be? How much of it would be towards equities? And within equities, what would your top bet be?
See, compared to Diwali at this point of time, due to the savage selling done by FIs in large cap, we are clearly more positive on large cap than we have been in September, October, November. And I think the time has come for you to do systematic investing in large cap and systematic transfer plan in large cap, because there's been so much FIs selling in large cap. But small and mid cap, we are still very careful and cautious at this point of time. And gold and silver is no longer an asset class where you can put big money in at this point of time because they've done too well. We are not that positive on dollar. We are not that positive on US NASDAQ at this point of time because those two have done very, very well at this point of time. That is where we are in asset allocation framework.
So, Naren, okay, let's just simplify this to wind up. I mean, if I have 100 additional rupees to invest today, what are you saying? How would you divide it? How much gold? How much equities? How much maybe cash or fixed income?
You can't put such numbers. You can't put such numbers so easily. But I would certainly say consider large cap, consider debt, consider anything else other than NASDAQ, small cap and mid cap. That is all. Safety
first. I think that's the takeaway from this discussion. And just as we wind up, Naren, I mean, on this whole tariff piece, this whole global situation, do you expect this to be a slightly more longer lasting risk? Because some of the experts this morning have been saying that this will probably blow over. This should be a temporary phenomenon. They'll get to the talking table and it should blow over.
I don't consider myself an expert. I didn't know it will come on Saturday night, for example. So I believe that it will come, it will go, it will come, it will go. I think we have to be prepared for volatility, and volatility is good provided you know how to handle it. And that is why we believe in asset allocation, which allows us to play volatility.
Got that. Naren, one sector, usually I don't ask sectors with you, but oil marketing companies, right? Look at HP, BP, IOC, the stocks will all come up. They're all down 6-7%. And the question many investors are asking is, I mean, looks like from what the numbers have been presented, they'll have to bear the LPG burden, the subsidy burden. Any thoughts? Have you looked at that? I mean, that risk is back.
Anything which falls off a cliff, and companies with good amount of assets and oil marketing companies like that, if you take a view that oil is not going to shoot up, I think those are all sectors which are not that bad after a big correction. That is how we look at things from a contrarian framework. So if a sector has fallen off a cliff and, these are all companies which can't be created in India any longer. So I believe that's why we wouldn't be so negative after a big fall, clearly at this point.
Okay, well, that's the framework, and always contrarian, one of the few true contrarians out there. Thank you very much, Naren. It's a pleasure having you with us here. Thank you for joining us here on the program. Well, markets have recovered, I must say. We're down about 160, which means about 50-odd points off the lowest point of the day. Nigel, that middle-class tax cut, will it go into spending on travel and hotels is the question, right?
Well, even with the high taxes, people were still spending on hotels and travels and luxury. So now maybe more.
Indeed. Before we get to the discussion, I just want to point out the sector of the morning actually is chemicals. Because the markets are down, but just take a look at the chemical companies. Your PI Industries are at the high point of the day. UPL as well is high. I think Aarti Industries was down close to 5%, and that stock is on the verge of moving into the green. And this was a sector that we highlighted at the start of trade. It could be the sector of the day. And the top three factors were there are key molecules that are being exported into the United States. China was a bit of a threat, particularly like for a company like PI Industries on pyrosulfone, that particular molecule, where people are saying that, China's adding capacity, that could be a bit of a risk. Now, that seems to have taken a bit of a back seat. And if you compare the current valuations with the 5-year average, it is at a bit of a discount. So that's why you're seeing some of these stocks that are doing very, very well on very large volumes. UPL, PI Industries, Jubilant and Griva. I think we should pull some of them up for you on the screen. But let's get to talking about the hotel space. In an effort to boost tourism in the country, the finance minister in the budget, the budget speech announced that the government will develop the top 50 tourist sites in partnership with states and also extend the Mudra loans to homestays. To talk about this in detail with regard to these developments, we are joined by Mr. Puneet Chhatwal, the Managing Director and CEO at Indian Hotels. Hi, Puneet. Good morning. Always good to see you in. Well, the infra status has been given to around 50 new tourist hubs. Is it a start? How happy are you about this? And also, if you could tell us, do you know what these 50 places are? And do you have any properties out there?
So good morning, Nigel. Always good to be with all of you on Monday morning, especially. And just listening to Naren, firstly, I have to say we are not suffering from any Saturday night fever. It was quite positive in our hotels. And I would like to believe that this week we will also benefit from hotels and not just from chemicals on a Monday morning.
You're in a mood. Puneet, you're in a mood.
Puneet, Saturday Night
Happy,
Fever,
happy.
you know, the song is ringing in my ears. John Travolta, you know, doing that dance, and it seemed to be in that sort of a mood.
See, that's what I was saying, that even without this 1 lakh crore rupees of extra consumption boost, Puneet's hotels and resorts and, you know, the convention centers, all of them were chock-a-block. But now, to get back to Nigel's questions, now more of it?
More of it. So now, of course, definitely more of it. See, we are going through a positive balance in terms of demand in, outpacing the supply. So that is driving growth in your like-for-like portfolio in the sector. And for companies like us, which are very strong, not like-for-like growth, we are witnessing a good increase on both the top line and the bottom line, and I don't see that changing. Now, over and above that, I would say some of the mention of tourism sector comes up in the budget, and which pleases me a lot. It's definitely a lot more that needs to be done. So let me start with the macroeconomic. The macroeconomic story is good because, as the previous speaker said, if your macros are on the good, then your disposable income, your discretionary spend will stay on the good side. There'll be less volatility. So I think keeping the deficit in check, kind of giving a stimulus to consumption, which means a lot on food and beverage, and especially on our portfolio at the lower end with the Ginger brand, and also incentivizing some of the growth in the new 50 destinations is very good for those who would want to, take benefit of loans and hire a moratorium period. However, when it comes to the direct recognition, besides the 50 new destinations, I think tourism and hospitality is a very strong beneficiary of the UDAN scheme. It is a big beneficiary of the skilling. It is a big beneficiary of the Mudra loan, especially on the homestay business, and also the ease of travel. Having said all these positives, the one negative is I would have preferred, or two negatives, that the infrastructure status was extended to entire India and not just to 50 destinations. It should not have been taken out at all way back in 2012, which is 12 years ago. Because it is very strongly linked to the UDAN scheme and other investments in the infrastructure. So hopefully we'll get there during the course of this year. And second is marketing India as a destination outside of India. We should have had a significant increase in budget, and that budget has been significantly reduced. So with the foreign tourist arrivals still behind the pre-COVID level, I think it would have sent a very good message, not just from a financial and foreign exchange earning point of view, but also the positioning of the non-economic value, the soft power of India across the globe.
So, okay, let's talk business now that we've understood the bigger backdrop. Puneet, given the demand, and that demand push has only gotten bigger, like you said, right? What is the increase that you think you can undertake in pricing, ARRs, even on the sort of the corporate demand side, conventions?
No, Surbhi, don't ask.
Shareholder question. Shareholders will say there's so much demand, will Puneet drive up prices? By how much?
See, it depends. Actually, first you also all have to, align yourself. You want an increase or you don't want an increase?
No, we don't want. Actually, let me rephrase the question. When are you cutting prices?
I think that's what my whole point on infrastructure was. With the change in the landscape, with the addition of facilities like Bharat Mandapam, with the Yashobhumi, with the Geo, there is a lot of demand coming into the capital of India and the commercial capital of India. What we have today gets filled up very quickly and it's not going to change. And that is going to drive the prices only one way, and that is up. With the change in consumption, with so much money coming back into people's pockets, I'm sure a lot of them would want to travel both within India and unfortunately some might even go outside of India. So I think rate stability and increase in rates is definitely in for the next few years to come, with limited addition in supply, but an increase in demand. And that is good for our sector.
Puneet, I'm a realist, and I know it's painful, and I think, Prashant was trying to wish it away, but I'm a realist. So therefore, I want to hear the truth up front. How much of a price increase over the next 2-3 quarters do you think you'll be able to push through with demand being so buoyant? 10%, 15%, less, more, some range? So we're prepared.
I think anything which is double digit is the right way forward, and that by saying that I'm also being realist, which means 10, 12, 14%, definitely not 20 or 25%. Some destinations will benefit because there is nothing that exists out there. Like even now, as we speak, for Mahakumbh, for that shorter duration of time, you could have 25, 50, 100% increase or 500% for a few days of Coldplay. But that's only a few days in a year. So I think the average across India, definitely we are in for a double-digit growth for the next few years to come.
Now when they announce price increases and we ask them why, they say, Surbhi ne pucha tha, Surbhi ne manga tha price increase.
Abhi sach hai, sach ka samna to karna padta hai, like they say.
All right, Puneet, let me ask you this. And you've seen this on social media, it's not new, right? People, all these posts complaining about, if you want to take a 5-star holiday in India, and if, say, a 5-star holiday overseas, right? Many Southeast Asian destinations, the cost is substantially lower. Don't you think that eventually will start to hurt demand? Just pricing, staying and sort of even going higher from here.
You see, Prashant, markets are, efficient in terms of the correction always takes place if you get totally out of control. I think if you look at the pricing point of view, a lot of other factors have to also balance out in terms of exchange rate for dollar versus rupee, in terms of GST that is levied. We still have a slab of 7,500 rupees plus at 18%. That 7,500 was fixed 7 years ago. So I think there's certain things which are beyond our circle of control. And there the fiscal policy helps. It's the airport taxes, it's the cost of travel, is all kinds of other things. I was talking to somebody very senior, and there are places where we have renewed our contracts. Let's say in Taj Mahal Hotel in Delhi, where we are paying 32.5% as revenue share in terms of lease to the government. So every 100 rupees, going back to, you gave an example of 100 rupees where it would be spent, 32.5 goes straight to our landlord, which is a part of the government organization. On top of that, you have GST collection. On top of that, you have income tax from so many employees who are working in the property. So I think taking just one dimension view of just the price is not the right measure, because, and also somehow we tend to only talk about this sector in pricing. I don't think anybody else talks about pricing in any other sector. This I've not understood. Since so many years,
No, I complain equal opportunity. Look at these flights, right? But Bombay and the Kumbh, they're 45,000 rupee flights, right? A family of 4 or 5 will spend 2-3 lakh rupees on flight. People are going, so I think there's just generally, it's not just hotels. The airfares also, I think, at least in some sectors, etc., have gone up, but take your point that it is, of course, markets at the end of the day. More supply needs to come, and hopefully with government support in terms of building out some of these destinations, the private sector will also invest, because, if the basic infrastructure is there, hotels will, tourists will come. You build, they'll come. I think take that point. Nigel, you want to come in?
No, I mean, I just want to ask, something with regard to this infra status that's given. Puneet, could you tell us how will this infra status help in lowering the cost of funds? Give us a brief idea. What is it and how much lower could it get?
Your basically cost of funds, you're able to borrow marginally cheaper up to 100 basis points, and your payment period or repayment period of the loan is extended. So basically that's what it is. And that puts you at par with other sectors. See, way back, as I mentioned in 2012, a demarcation was made and projects north of 200 crores and convention centers north of 300 crores were excluded, which I think is wrong, because when you're building such great infrastructure in major metros, you actually need more beds to come in and more hotels to come in. And this being a very capital and labor intensive sector, it would be more aligned with the government. And the same thing on, I know you asked for infra, but I would still like to add international marketing fund for marketing India in various destinations abroad is a positive step over the next 10, 20 years.
All right, Puneet, it's good going for your sector, and obviously, I mean, there is extreme buoyancy in demand as well, plus the government help coming through. So I guess it's all going in the right direction. Thank you very much for joining us in the conversation today. Great chat. We look forward to talking again very, very soon. By the way, thank you so much. Prashant, did you hear what he said? The revenue that they're sharing with the government on the Taj Mansingh property in Delhi, that's gone up by 30%.
Right.
So to go back to your earlier concern about lesser collections with the government, GST that we're going to pay in the hotels will go up. The revenue collection, the airport hike, again, Delhi airport, the tariff increase, government is earning, it seems like. No problems there.
Absolutely. And, it's more expensive for you and me. Well, 240 points lower on the Nifty is what you have. So basically, there's another round of selling which has happened. There was a 50-60 point recovery. We were down 150. We're down about 240 points now. So almost at the day's low. We'll take a quick commercial break here. You'll hear from the top equity strategists in the country. Rhythm Desai of Morgan Stanley will join in to decode the macro and the micros from the budget. But it's not just the budget, right? There's tariffs and more stuff which has happened since. So all of that coming up.
Welcome back. We're continuing the coverage, decoding the impact of Budget 2025 and also looking at markets right now, which are reeling with the other issue, which is the whole tariff situation. Right now, the Nifty is down about 250 points, and we're not that bad off, and markets have kind of tried to hold this ground. Rhythm Desai is our next guest on the show, and of course, their latest note is out. Managing Director and Chief Equity Strategist, India at Morgan Stanley. Rhythm, great to have you on the show. There's so much to talk about: tariffs, budget, capex, consumption. But you know what really caught my eye in that note of yours, that contrary to large pockets of the market, where people are saying go to safety, go to large caps, you are still retaining your bias for small and mid caps, and you still see scope in that side of things. So let's open with that, why you don't think that mid caps and small caps are flashing red.
Hi, thanks, Surbhi, and great to be on CNBC. So this has to be contextualized. And we have to bear in mind that the news from outside India is not so good. So keep that aside. We'll come back to that subject a little later in this conversation. But the news from India is going to get a whole lot better in the coming weeks. So we've gone through a mid-cycle soft patch which has, I think, lasted for about 5 or 6 months. It was rather idiosyncratic, led by extreme weather in August, elections in the first quarter, lack of spending by the government, and a little bit of tightness on the monetary side. So all this has assimilated into a slowdown in growth, which hurts SMIDs the most. And of course, at the starting point, the SMID valuations were looking a little extreme, and that correction has happened. I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up. Of course, as I said at the outset, the caveat is what happens in the rest of the world, and we can come back to that conversation. So that's the reason why I think that after this steep correction, now SMIDs are looking better than they have been for almost 7 or 8 months.
Rhythm, you've retained your bullish view, and you've been the outlier bull on India throughout the last 4-5 months where we have been going through this correction. Now you're saying things are looking up. You're expecting growth to pick up, but up for what side of the market? Consumer or capex? That's the current debate.
So, I mean, if we take it only in the context of the budget, this budget has actually given a fairly strong fillip to capex. So the total capex as a percentage of GDP from the central government is going up from 4.1% to 4.3%. The 4.1% was already an all-time high. So we're making a new high in the subsequent 12 months. And unlike the trailing few months, I think this 4.3 looks a bit more achievable. You must bear in mind that the government capex in nominal terms in the central government's budget has more than tripled in the last few years. And they did, I think, hit a bit of a capacity constraint. If I would simplify this, this is like if, you are given tons of money to spend and told no wasteful expenditure, but go and spend it. There's a limit to how much you can spend. And that capacity only builds over time. So we have kind of tripled our railway spending. We've significantly increased our road spending. And as I said, overall, capex is up more than 3 times. So I think that's where we hit a little bit of a wall in the past few months. And the government is overcoming this by opening up new sectors for capex. And 3 new sectors stand out in this budget. So one is water, the second is distribution, and the third is housing. So the capex is moving away from what we saw in the last 2-3 years in terms of subsectors to new sectors. So if I were to use one word, I would say it's a capex-oriented budget, but of course it also has a big consumption stimulus via income tax cuts. So it has achieved both, which is why I call it a magic budget, and also actually achieved fiscal consolidation slightly more than what the market was anticipating. So that requires a lot of work, which I think the finance minister has done. And the budget numbers look quite good, actually. So it's not like these look, a little outrageous and there are some, crazy assumptions. Absolutely not. If anything, I think they'll probably surprise to the upside. Again, caveated by what happens in the rest of the world.
Hi, morning, Prashant here. And good to see you back after a while. I think you've given us the headline. It's a magic budget. The piece on consumption really, Rhythm, how much will this help in your opinion? And what will see that lift and that help? Which subsectors within consumption, in your opinion?
That's a good question, Prashant. It's not as obvious as it seems. So let's contextualize this. This is about 10 million people, 1 crore people who are getting this tax break to the extent of 1 lakh crores. And it's not necessary that they will take this tax break and buy soaps from it. Okay. So I think consumer staples is certainly not the place where we go to. Consumer discretionary, I think, is a much better bet. And even there, I think at the higher end of consumer discretionary is where I think you will probably see some of this tax saved being spent. Some of it can actually also come into the stock market. All of it will go to the banking sector. So, so this is how I would break it up. And that's, the dilemma always with tax cuts. It's hard to predict what people benefiting from a tax cut will do with that money. They could just simply deposit it in the bank, or they could go and buy shares, or they could use it to buy some high-end goods. And I think you'll get a mix of all of that. Now, the exact mix is very hard to predict, but it'll be a mix. And all this is actually auguring well for the economy. When you've hit sort of a spending capacity limit and you don't want to do wasteful expenditure, and again, we should highlight this point, and I'll come to this in a second. So just give me a second. When you don't want to do wasteful expenditure, this is the best next alternative you have, which is give it to the people to spend. And that's what the finance minister has done. So kudos to her for that. Now on wasteful expenditure, again, yesterday's newspapers had no mention about this. The subsidy spending of the government has gone back to pre-COVID levels. It's now back to 1% of GDP. And we had achieved a multi-year low in 2019 at 1% of GDP. So it's, I think, 1.07 if I remember correctly. So the wasteful expenditure is, it's almost you're wringing the neck of your spending options. It's like you're tightening your purse strings. And at the same time, you're getting the private sector to increase its participation in the economy. The way I characterize this is that the government, and I think this is common knowledge now, the government did the heavy lifting coming out of COVID because private sentiment was weak. It is now stepping away and reconsolidating the fisc, in a way preparing for the next crisis moment. Because when another crisis moment arrives, if it ever does, you need spending capacity in the government. So you need to be always prepared for it. And now the private sector takes over. This is incredible, actually, if you think it from a stock market perspective. Very few countries in the world have this flexibility which we have, which is we can take the foot off the pedal, consolidate our fisc, and create capacity to address any upheaval that can happen in the coming years. And that is why this budget is magic. I mean, just one of the reasons. I mean, there are plenty of reasons why it's magic, but this is one more reason why it's magic. And I'll come to a third reason a little later, which is the fine print of this budget.
And we'll just come to that in a bit. But and I think that's very beautifully put, sort of explained in that sense. Just to go back to what we began the conversation with, small and mid caps, right? Now, Rhythm, but what about valuations? Because if you look at Nifty, this is data as of Friday's close. We were doing, I don't have the numbers now, but we looked at the Nifty 1 year forward multiples are slightly below the long-term average. If you look at mid-cap multiples as relative to Nifty and small-cap relative to the Nifty, they're still, even after this 18-20% fall that we've seen, they're still very rich compared to historical averages. So how should one put this in context?
So see, Prashant, I hate to look at valuations in PE terms. If I were to make this really simplistic, PE is nothing but price expressed in form of earnings. Like you would say price in INR, price in dollars, price in earnings. It doesn't tell you anything about what the value of a stock is. Ultimately, the value of a stock is the future cash flows discounted at your expected rate of return. The future cash flows from a stock is dividends, which come out of earnings. So that is a very different thing compared to what PE is. And PE can be very misleading. So there are many moving parts to this and why Indian stocks trade at the valuations they do. So the first and foremost thing is terminal value. There are very few countries on the planet that have any terminal value. Take the case of China, where I think the terminal value is close to zero now, which is why stocks in China seem so cheap. They are not cheap because ultimately equities require long-term growth to drive their value up. And India is, again, one of the few countries where long-term growth seems to be quite good. The second is the rate at which you want to discount future cash flows, right? That has fallen in India. Why? Because India's economy has become more stable. One of the messages from this budget is that we're not tinkering with macro stability. And not tinkering with macro stability makes our returns or growth more predictable. And what more can be sweeter for equities than predictable growth? If I tell you that a company's earnings, come what may, will compound at 20% in the next 5 years, you will pay up for that stock because predictability is the best news for equity investors. And by pursuing the type of policies that this government has done for the past 11 years, it is actually making India's growth more predictable. And that is why equities trade where they trade. They're not going to become significantly cheaper. And trust me, when they do become significantly cheaper, you will not want to buy them because it will happen in this moment where somebody comes in and disturbs this macro stability.
Hi, Rhythm. Good morning and good to see you. When you're sounding very, very optimistic about prospects, and that's good to hear. And in the finance minister, with regard to the budget, the expectations, they are factoring in STT to be much higher as well. So maybe they are factoring in a buoyant stock market as well. Give and take everything, Rhythm. How do you change your portfolio from here on? What are your top ads? What have you all deleted as well? I'm looking at it. I think HAL is something that you'll have pulled out, while Titan, Jubilant, those are the ones that you're relatively more optimistic on. So give us a portfolio construct.
Sorry, so I won't go into single stocks, but from a sector perspective, I think you want to buy the banks, particularly the private sector banks. I think that's the easiest trade in the market right now. The stocks are trading relatively attractively, and I think the environment is going to get more constructive for banks. So that'll be the easy one. Then I think you want to buy some discretionary consumption. As I mentioned to Prashant, this budget is, I think, built for an uplift to discretionary consumption, especially high-end discretionary consumption. I would still continue to back industrials, though within that portfolio, you have to realize that there are some shifts that are happening with respect to the subsectors in which CapEx is taking place. So you may want to orient yourself to that. I think technology looks quite okay. We are getting into a period where spending cycles seem to be going up. Everything else, in my view, can be underweight in a relative portfolio. But this is one point that I will make, is that this market is transitioning from a macro one to a micro one. So since COVID, we've been driven by macro factors. And I think increasingly this is becoming a stock pickers market. So it's really not about the Nifty and where it heads. It's about individual stocks. And I think the dispersion of returns across stocks is likely higher in the next 12 months than it has been in the last 2 or 3 years.
Absolutely. So just reiterating for the benefit of our viewers, Rhythm, you're saying that private banks are an immediate trade. You also like consumer discretionary. I want to go back to the three new lines of CapEx that you outlined. You said water, housing, and you said distribution. I think you're talking about logistics over there.
No, electricity.
Oh, electricity. Okay. So then the same question, how would you place stocks along these lines? Because you're still, relatively not too negative on CapEx.
Yeah, so CapEx spending in nominal terms in the budget is up 17% to around 15.5 lakh crores. So that's growing faster than their normal GDP assumption, which is why CapEx share in GDP by the central government is rising. What they've done in the budget is they've transferred some of this spending power to the states. So the allocation of grants to the states for capital spending is up almost 1,30,000 crores on 3 lakhs, so nearly 40%. And that is that's the gist of this budget, that the states are now being incentivized to undertake CapEx. And you think about the macro context here. There has been a growing risk of greater revenue spending by states for subsidy programs or for distribution. You want to reorient that spending. So the government of India is using its resources to help the states reorient that spending to CapEx. Another reason why I call this a magic budget. I mean, there are so many reasons. We didn't even go into the fine print. Allow me to go there. So all these years, 35 years of doing budget, the fine print has always contained bad news. I've never seen a budget with fine print that had good news. This budget actually had some really good fine print. It has diluted permanent establishment rules. It has created safe harbor rules. If you think about Make in India, I think this is a budget that really powers Make in India. A lot of multinational companies will be looking at this fine print and saying, oh God, we can now come in, it looks safe.
Okay, and I think it needs a proper fine print discussion, but we're always on the clock. You know, somebody's a large individual investor has messaged me and said, please ask Rhythm about when FIIs will return in the context of all the changes made in the GIFT Nifty. Quickly, if you can.
GIFT City, you mean? The GIFT City.
So,
GIFT, sorry, what did I say? GIFT City, yes.
GIFT Nifty.
Yeah, sorry.
Every morning at 9:15, there's a $100 million bid that comes from domestic investors. To do a trade, somebody needs to sell. Either corporates sell through IPOs, and then they'll allow FPIs to buy, or the FPIs sell. So this is the technical point. Okay, the GIFT City changes, I think, are very encouraging, and it should assuage a lot of foreign portfolio investors with regards to taxation, and should encourage them to step in. And these are changes that market participants were pressing for, and the government has delivered. So I would be very optimistic, but I think you need a bit of supply of paper for foreign portfolio investors to turn. Mind you, this selling that we have seen over the past few weeks has little to do with India. It is largely an emerging market problem, and the emerging market asset class does look very vulnerable. We actually did not get to that at all. But what's happening over the weekend and what's likely to happen over the next few weeks is going to create volatility. So people have to be prepared for it. And India may outperform in this volatility, but the Nifty will struggle. If the world is not going up, it's impossible for the Nifty to do its own jig. It's a very large market now in a global context. So it cannot do its own thing if everything else is falling.
Absolutely. A longer fine print budget conversation soon, Rhythm. You're calling it the magic budget. Thank you very much for joining us here this morning. Lovely conversation. As always, lots of insights and perspective. Take a quick commercial break here. See you on the other side.
One, two, three, four, five, six, 7, 8, 9, 10.
इलेक्शन बढ़ जाएगा, ये बढ़ जाएगा, वो बढ़ जाएगा, सरकार तो कमाई लेती है, यहाँ से नहीं तो वहाँ से.
But really, economy में pain है.
Yeah.
I met somebody very senior at
Welcome back. Let's straight away take the focus to the commodity markets now and see how they are reacting to the tariff wars that have been unleashed. Manisha, good morning.
Morning, and thank you for that. Well, I'm looking at copper, aluminum, zinc, and most of these metals are trading 1 to 3% on the lower side on the London Metal Exchange. Well, that's the major market that you watch out for in the global markets. We have seen US announce tariffs on Canada, Mexico, and China as well. Well, 25% on Canada and Mexico and 10% on China. Importantly, when you look at all of those numbers there, Mexico and Canada support, or rather export to US is around 75% of their total exports. But when you look at the US exports to both of these countries, that stands at around 16 to 18%. So we can see it's very lopsided in sense of numbers there. But I quickly want to come to individual metals here and talk about copper. And US is the net importer of copper, aluminum, and zinc. And that's the reason you are looking at very strong premium in case of the US markets for many of those metal prices there. When you look at the copper numbers at it itself, the US is importing 36% of its copper from Canada and Mexico. 36% actually is exactly the number that US actually imports in sense of copper. And when you look at the prices right now today in Asian markets, we are looking at 6% of a premium reigning in case of the US markets versus the London Metal Exchange. So you are looking at a lot of hoarding, buying coming in, and that tariff impact already showing into the prices there. Talk about aluminum, and US imports 82% of its refined aluminum, and much of that really comes in from Canada and Mexico to the tune of around 60%. So we are looking at aluminum prices also trading at a huge premium when it comes to the US markets there. Talk about zinc, and US imports nearly 67% of its zinc requirements also coming in from the Canada and Mexico markets there. Canada supplies 50% of its zinc to US, and we are looking at zinc prices in the US markets trading higher, but zinc prices on LME right now are trading at around 2-month lows. We've seen a 3% of decline come in for the zinc prices in the Asian markets right now. Steel is yet again an important commodity, and we do see steel imports represent 17% of total imports in sense of US there, and 40 to 50% of steel comes in from Canada and Mexico into US, and we're looking at perhaps tariffs coming in for this one as well. Importantly, the US president has said that he would have a conversation Monday morning with Mexico and Canada as well. Remember, these tariffs come into being from 4th of Feb, so we still have today in sense of negotiations and conversations, but the market's already taking cues from these tariffs, and we've seen big arbitrages coming in for US, LME, and the Chinese markets there.
All right, Manisha, thank you very much for that. Commodities in focus. Up next, my colleague Latha will be in a conversation on the budget implications. She'll have B. Prasanna of ICICI Bank and Kaushik Das of Deutsche Bank to take you through, of course, the latest, which is tariff announcements, implications for global markets, rates, currency, all of that coming up. Interesting conversation.
Welcome back. Before the rupee or the bond markets could react to the budget, these markets have got shaken by the tariffs imposed, or at least threatened to be imposed, by President Trump on Mexico, Canada and China. The dollar index up 1.25% from where we left off on Friday, and the rupee is at a new low. It's fallen 0.75%. I mean, I've not seen this kind of a sharp fall in a long time. It's about 75 pies cheaper than where we left it on Friday. 87.20, it even went to 23 per dollar. The government borrowing for FY26 is very marginally higher than this year's and versus what the market was expecting, but that's really a rounding error. Despite this prudent budget, will the Reserve Bank have the guts to cut rates in the face of so much external uncertainty? I have with me two guests, B. Prasanna, the head of global markets at ICICI Bank, and Kaushik Das, the economist from Deutsche India. Gentlemen, good morning and thank you very much for joining me. Prasanna, I'm cutting the budget for the moment and going straight to what is, a huge issue on the currency markets today. Do you think this uncertainty can impact RBI decision-making in a big way?
So I think, yes, Lata, markets being markets, budget is already history, and within a day we have got so much of information that markets are now reacting to other kinds of movements. Yes, I think the uncertainty is increased to some extent. I think all of us in the markets were expecting some kind of announcements from Trump on the day he was actually taking charge as president, or in the first 1 or 2 days through executive orders. But the kind of bonhomie that was there between him and Xi and the other presidents kind of, got some complacency into the international global markets again, basically with the view that Trump might not go all the way. But I think clearly what has come yesterday has surprised the markets, I would say a little bit on the shock also. And the fact that it's not just announcements, but they're actually going to start collecting tariffs from tomorrow. So I think the natural reaction for currencies would be to depreciate. The non-dollar currencies will depreciate against the US, and what's happening in INR is also more of the same. As far as your question on RBI is concerned, I would say that in a normal situation, maybe RBI would not be cutting rates when the currency is depreciating. But what is happening right now is a part of a global move where the dollar is strengthening and all the other currencies are depreciating. It's not because India's current account deficit is weak. It is only India's balance of payments are weak only because of the capital flows, which actually means if you actually cut rates and can get better earnings on the corporate side, you can get better growth and hence hopefully a better flows going forward. So I don't think it derails the rate cut, but at the same time, I would also have to admit that the uncertainty is killing. So, I mean, the odds, I mean, we'll have to see what the RBI does.
Okay. Well, there is one argument which is constantly put that after all, India has not got so much of bond inflows. It is not interest rate differential that foreigners are vying for. Foreigners come to Indian equities because India is a growth story. And there the rate cut will actually help. So will that cut, at the moment, what are the odds, therefore, for a cut?
So, Lata, the question is to me. What I would just say that the argument is sound, but I also would have to say that we are not out of the woods as far as the global dollar strength is concerned. I think we need to see it playing out, and I don't see international investors returning to India in a hurry, unfortunately. While I think the budget is very good and it is played within all the parameters of fiscal conservatism, while at the same time pushing consumption, not compromising on capital expenditure. But the thing is, it has to start reflecting into corporate earnings into India, which might take maybe a couple of quarters. And the dollar strength will have to play its course, and we'll have to see it peaking. And then only, I think, international investors will even start looking at, the rest of the investing asset classes.
Fair point. Kaushik, that straight away lobs the ball into your court. Do you think that given the kind of noises the budget has made, push the pedal on consumption, are you changing your growth forecast at all for next year?
So, Lata, we already have a growth forecast of 6.5% for next year, FY26, which is somewhere in between 6.3, 6.8, which the economic survey has kind of indicated. So we don't need to change that forecast, but the point is that 6.5% growth is probably below the potential growth rate of the economy. And this year also, we are supposed to get something in between 6 to 6.4%. So you need some support. Now, the point is the budget has done the maximum that it could do given the fiscal space. Beyond that, we should not have expected more. But then I've always maintained two things. One is you cannot depend solely on the fiscal to support growth, given that they have to keep on consolidating. Therefore, monetary policy has to play a bigger role, and RBI has been on hold for 24 months when the maximum in the past has been 11 months of a wait period. So we are already late, and RBI has started these liquidity easing measures, which will help, but they need to do more. And rate cuts, there's no point delaying it, because today you have this uncertainty because of US tariffs. If you decide to, kind of wait and go in April, even in the first week of April, you could have the same uncertainty, and you could keep on delaying this. So the second important point is that you cannot, link interest rate and FX policy at this point of time. FX has to, have its own course. It should be a risk, absorber kind of a, objective. So if the rupee has to depreciate because globally dollar is strong, that should be the path. RBI can, modulate that move, but it cannot use the interest rate policy as a defense for the FX policy. The interest rate policy should, kind of focus more on the domestic. Demand, fundamentals. And over there, we think some bit of rate cuts are required in February and April, along with liquidity easing measures.
Okay, so there, I'm glad you brought up the liquidity point. Prasanna, should we expect a CRR cut? Because clearly what is given is not enough. That's,
Yeah, Lata, I think till end of the year, our estimate is around 1 lakh to 1.25 lakh crores of further liquidity infusion is required at the minimum. But the fact is, RBI did not really wait for the policy to implement some of the liquidity measures, and also they have been pretty aggressive in their in commencing their liquidity operations. You've seen them announcing auctions of 60,000, 20,000 has already happened, and not only that, they have now also more aggressively buying in the secondary market on the screen in government bonds. So the sum total of all of this will give you around 1.5 lakh crores. But like you rightly said, it's just not enough. And one call that the RBI would need to take, obviously, is that since they have moved from withdrawal of accommodation to neutral, and maybe they don't move the stance from neutral to accommodating stance, but at the same time, they can take a call that they want to keep liquidity flush with the banking system rather than making the banking system borrow from RBI using whatever tools like VRR. If that is the case, then they will need to give more than 1.5 lakh crores also. So that's a call they have to take. But since they have already announced a lot of measures, I'm still not willing to rule out a CRR cut, but the probability has come down, Lata, of them doing a CRR cut. They'll probably use a combination of OMOs and buy-sell swaps going forward to, infuse this liquidity. Because somewhere I feel that at 4%, they feel that 4 to 3 cushion, which they want to keep, I think they want to keep it for a crisis situation. I won't call this exactly a crisis.
No.
Yeah.
No, I take your point. We are nowhere near taper tantrum or Lehman kind of. We are not at all in a crisis. Kaushik, therefore, what's the in-house view on the dollar rupee? Are we at the low, like 87.5 thereabouts? And what kind of a bond yield range are you looking at, Kaushik? I thought you're factoring in 2 cuts.
Yeah, so Lata, a couple of things. One is dollar rupee. I think this year you will see more two-way movement. It's not like obviously now rupee is under pressure, it'll depreciate, but there's a point of time when DXY will also peak. And you'll see other currencies appreciating when all this fear factor is over. I think at that time, RBI will allow INR to appreciate as well compared to the last few years when INR never used to start depreciating from. So taking all that into consideration, I think, rupee could be at 88 by the end of this year. So it could move to 88 first, and then you could see a appreciation at some point of time back to 86.5, and then again go back to 88. So I would say 88 would be the range for rupee going forward. As far as bond deals and interest rates are concerned, just to add a little bit more on liquidity, I feel that RBI will not be cutting CRR anymore. They have done it already in December. Beyond 4%, they would not like to move. As Prasanna said, this is not a crisis-like scenario. They can do more buy-sell swap, another 5 billion. They can do more OMO purchases. And, once they have started OMO purchases, already it will be about 90,000 crore this year and maybe more this fiscal year, and more would be coming in the next fiscal year. I would assume more VRR more OMO, more FX swap, but not CRR at this stage. And if you've seen carefully that the 56-day VRR is supposed to happen from 7th February.
That's right.
That is the day when RBI, if it delivers a rate cut, people would be willing to take that money. And you'll see that 56-day falls on the next policy on 4th April rollover period. So I would expect 2 rate cuts on February 7th and April 4th, coinciding with the 56-day VRR rollout. Bond yields probably would be somewhere around these same levels because market has already priced in 50 basis points rate cut. If there are more expectations of rate cut going forward, then you could see bond yields falling more than where we are. But more or less, we are at that level. But the negative side is also not that much because we have...
That. Yeah, got that. No, I got that. And that's good calculation to show exactly why you are expecting a rate cut. If you do a 56-day repo before February 7th, obviously you bankers will not buy it because you will be expecting the rate cut. I take your point over there. That kind of seals the rate cut. Very quickly, Prasanna, something which I think equity analysts are not speaking about much. I'm going to ask you an unfair question. Do you think banks' retail loans will go up now? This is a pro-consumption budget. A large number of people have 1 lakh rupees more or are going to pay less tax. Isn't this a pro-retail loan budget?
So I think, Lata, I think it's too early to comment on that. Yes, it is a fact that the 1 lakh crore of giveaway on tax will probably lead to something like 75,000 to 77,000 crores of incremental consumption, assuming a marginal propensity to consume in that region. But and that also happens on a recurring basis, adding to every year's GDP. But that's too early to say at this point of time. I think what the Reserve Bank does in terms of signaling, in terms of risk weights, in terms of what happens to EMIs, I think some of those things are also going to be important in terms of what happens at the credit growth level. And just to quickly, complete the circle on the rest of the things that you asked,
Rupee and bond.
was basic. Yeah, so it's basically on the bond yield side, we believe that there will be a bullish steepening with now the rate cuts getting starting to get priced in at the shorter end of the curve, while at the medium end and the long end, maybe not as much. So because the absolute level of yields are also on the lower side and it doesn't make it too attractive for banks to keep buying at lower and lower yields. So I would say 660 on the 10-year by 31st March and 650 to 660 kind of range for the calendar year at the end of the year. And on the INR, I would agree with what Kaushik had to say, which is that this year we are going to see a little bit of two-way movement. Hopefully, RBI allows the rupee to appreciate also when the dollar has peaked. We haven't seen them allowing the rupee to appreciate because they were very keen to pick up reserves when rupee was appreciating. But this time around, since they're also allowing the depreciation, like you rightly said, 0.75% depreciation today compares favorably with some of the other EM currencies which have depreciated 0.5% today. So from that perspective, if you allow the rupee to depreciate, you should also, kind of allow the rupee to appreciate as well. So a little bit of more two-way movement, a little bit of higher realized volatility in the FX market, which will then also encourage corporates to hedge. So those are all the good things. And frankly, monetary policy should not, the currency movement should not come in the way of what they want to do for monetary policy, because that will be focused on supporting growth. And India's CAD is still very strong.
Okay. Point taken. Thank you very much, gentlemen. Unfortunately, out of time, but very important takeaways. We have to wrap up on Bazaar on that note. Chartbusters coming.
Those 50 places, यार, if there चल ठीक है, वो भी नहीं बताया तो eventually बता देना what is the difference if everyone will come and say, oh, intra-status is great for us. So what happens? Do you get lower interest rates? Yeah, if he gets lower interest rates, then
worse interest rates and more time to pay.
Yeah,
please.
So that will impact others a lot more positively than him because he's anyway cash positive.
Correct. Exactly. ये देखा? हाँ, yes.
उसके बाद about the hotel sector, ARRs and all, you can talk to him every week. Now he comes whenever he wants to.